Catherine Pattillo is the Deputy Director at the Africa Department of the International Monetary Fund. She's joining us from the line in Washington, D.C. Thank you very much for your time. So in this report, the IMF has cut the growth outlook for a lot of these advanced economies. The US and China cut by over 100 basis points, for example. But the outlook for Sub-Saharan Africa largely unchanged. Why?
Thanks for that question on the growth outlook in Sub-Saharan Africa. Countries in the region are definitely facing greater uncertainty going into the second half of 2022. Back earlier in April, the war in Ukraine sparked this very large surge in food and fuel prices, which set back the region's recovery from the pandemic. Our numbers then are growth of 3.8% in 2022, and that's coming down from a better than expected 4.6% in 2021. The outlook, though, is full of risks. One of the reasons we didn't mark down much is that, though in the first couple months of the year there was strong performance. But there are a number of major risks looking forward, which may lead to downward reductions in growth going forward. Mention a couple of those. First, the slowing global growth outlook itself. As you mentioned, this slowing growth in China, US, European countries, which are the region's main trading partners, then could have negative implications. Second, tightening global financial conditions. So that can lead to increased financing costs and for some of the frontier markets, lack of market access. And third, commodity prices themselves. So oil and metals and some other commodity prices have reverted then from highs. And this is a positive then for growth for the commodity importing countries, but a negative for growth for the commodity exporting countries.
Indeed. Let's focus on one of those commodity exporters, South Africa. The fund did raise the country's growth estimate for this year, marginally, 40 basis points, going up to around 2.3%. And that's despite some of the worst power outages that we've seen in the country. Walk us through that methodology there.
Indeed, our growth forecast for South Africa was revised up largely on the basis of, again, a very strong Q1 outturn, which was driven by very robust growth, particularly in the services sector. There were adverse developments, domestic developments, one of which you mentioned, the very severe power cuts, as well as the flooding in the port of Durban and strikes. So if not for these, we might have revised further upward. But on net, then, given the strong services growth and netting out these negative, there was a growth revision upward.
Right. So we've seen central banks across the region. South Africa had a fairly aggressive rate hike, 100 basis points at the last meeting. Ghana and Kenya have opted to hold in their most recent meetings as well, but they also did raise a little earlier in the year, around May. They're all raising policy rates in response to inflation. But in many of these economies, like Ghana and in Kenya, for example, the root causes of inflation, food prices going up, fuel prices going up, a lot of this is imported inflation. So in that sense, what are the downside risks of central banks raising rates as aggressively as they have?
Indeed, we saw a number of central banks in the region raising rates earlier in anticipation of the rate hikes in advanced economies. And since then, countries are reacting to the higher food and fuel prices, as well as some other pressures, exchange rate depreciation pressures and capital outflow pressures in some countries. And when those are acute, then clearly the priority then is raising rates. But as you said, the drivers of inflation in many countries are external, and it's important then for policy to balance and be very data dependent, look at the developments and the numbers, and raise rates as needed, but be cautious. So making sure that inflation doesn't get out of control, but also not strangling growth. And in many countries, then a positive is that central bank credibility, because of stronger monetary policy frameworks, has been improved over time. And so those countries then may need to raise rates less in order to ensure stable inflation expectations.
Indeed. I just want to move on the conversation onto the question of Sdr locations and debt, because I know we're relatively short of time. Roughly this time last year, Sdr general allocation went up by 650 billion. Africa's allocation in that entire lot is roughly 33 billion in new Sdrs. But do we know how many countries in the region, A, have utilized their allocations, and B, where do we stand on these pledges from G20, G7 economies to essentially contribute part of their Sdr allocations to countries here in Africa to help them deal with the debt crisis that we're seeing on the continent?
So for the latest data, around 17 or so countries have been net sellers of Sdrs in the most recent time period. But I think the more interesting way to look at it is that this Sdr allocation, which was very welcomed by policymakers in the region, came at a critically difficult time, and countries then have been having a very appropriate thinking about the mix of either saving this in foreign exchange reserves or using then for fiscal support. So a large number of countries are finding that balance then between saving in foreign exchange reserves and using for fiscal support. Some countries have also used the Sdr resources then for external financing needs, and a few to repay more expensive non-concessional debt. And then on your second question on the 100 billion pledge by G7 and G20 economies, first, we are making good progress for the pledges for the PRGT, which will allow us then to extend further our concessional lending to low-income countries. We're about 2/3 of the way to the target for that on loan resources. We also need subsidy resources in that context to make those loans concessional, and there we're about 1/3 of the way toward what's needed. The other use that this rechanneling of Sdrs will go to is supporting the new Resilience and Sustainability Trust, which will allow the fund to support countries with structural challenges like climate and pandemic preparedness at long maturities. And we're also making progress there. The goal is 45 billion, and we're at about 37 or so.